Welcome to the Allan Reports TV. I'm your host, Allan Labucan from allanreports.com. Today we have a sort of a annual special event. We're going to be doing our Outlook 2011 report on today's show. We just issued this yesterday, actually, to our subscribers. We send that out if you're a subscriber to our email list. We send out all of our updates and reports. Anybody who's interested in getting a subscription, if you're watching this show on our website, just look above me. You'll see a subscribe section, and that's where you go to fill out the information, and then we'll put you on our email list and send you our updates or reports in this case. And so we're going to talk about a lot of different assets in the report, and we'll be doing that shortly. Before we get started, we always like to start with our thank yous. We use YouTube and Ustream.tv to broadcast and produce these shows, and so you can watch them at your leisure. Our primary website we use is YouTube. That enables us to be able to broadcast the shows not only on our YouTube channel, but here on our website. And so I want to thank those two. If you're interested in doing online shows, they're great websites to use. Then, of course, if you're watching the show on our website, you'll notice to the left and to the right of me that we have banners on our website. Those banner sponsors are really important in us being able to bring these shows to you. If you're interested in doing some homework on those companies, you would just click on their banner. That'll take you to their website where you can do your homework on those companies. They've got plenty of information about their projects, their news, and it's a really great place for you to start out your research. And to you, the viewers, you afford us an audience that gives us a chance to talk about commodities, resource stocks, and these are things we're really excited to talk about. So thank you very much for tuning in. So we'll get right on to it now. I'm just going to move some stuff around on my screen here. So for the last few years, well, each year what we do generally at the beginning of the year, we tend to do our forecasts for what we see happening in the year ahead. We kind of formalized it a few years ago for our Outlook 2009 report, and that's when we started calling them their Outlook. In that case, it was the Outlook 2009. The next year was Outlook 2010, and this year is our Outlook 2011. We started this year's report out by sort of giving an update on what we've sort of changed about our reporting on the markets. In the past, we did a lot of our reports in our email newsletter, and then in the early part of 2010, we started doing these online shows. And what we found is that a lot of the people that have subscribed to our reports sort of found out about us from when we've done TV interviews on Business News Network up here in Canada. That's BNN.TV and BNNTV.ca, I believe, BNN.ca. And so a lot of our viewers or subscribers found out about us from those TV interviews, and it became, we sort of figured out that as sort of a natural fit was to be doing these online shows. And one of the big benefits of doing the online shows is we can put them out more often, do timely commentary, keep in touch with everybody on a more regular basis. We used to only do our email newsletters was about once every 6 weeks or so. And another thing that became apparent early in 2010 was that because we're a small company, trying to do the write the email newsletters plus do the online shows was becoming very challenging. And so and it also started kind of get a little redundant. We talk about what we were doing, on the shows, and then to also talk about it in the reports was getting a little cumbersome. And so we kind of made the decision to focus more on getting these shows up and running. In the future, we may do more writing. We'll sort of play it by ear. For the time being, this will be our main focus. And we talked about that in our reports. Then we got onto our Outlook 2011. And what we always try to start out with is, in the intro to the Outlook, in this case Outlook 2011, we sort of look back on the year prior, or the past, because that has a big impact on what's going to happen in the future. And we started out by mentioning that, both our Outlook 2009 and our Outlook 2010, we had very good results, very accurate market calls. We feel that it's very reasonable to rank the quality of our calls highest amongst our peers, and we're working to keep that going this year as well. And then we got into a little bit about the past decade or so, and really for the past 10 years or so, the best place for investors to get the best results or best returns was in commodities and resource stocks. And a lot of that had to do with the reality of long-term supply and demand trends. We talk about this often because we think it's the most important issue relating to the price direction for commodities is what's happened with supply and what's happening with demand. On the supply side, there's been a few decades of underinvestment in the exploration and new development of deposits to become future producers, and this has really weakened the supply chain. At the same time, you have very strong demand coming from China, India, other emerging economies, and developed economies. And this demand is significantly stronger than the supply chains. And so these are the main reasons that we see why commodities have been performing so well and resource stocks for the past decade, and we feel they will continue that trend into the future. And so our underlying call was that in 2010 and prior to that, the best place for investors to get exceptional returns was in commodities and resource stocks, and we feel that trend will continue for 2011 and into the future. And then we got into our market calls, and we start out with the stock markets. The key markets that we talk about are the Dow Jones Industrial Average, the S&P 500, the Toronto Stock Exchange, and the Toronto Stock Exchange Venture Market. And the main reason we follow those markets is that this investor sentiment towards stocks can be very similar no matter when there's big moves in either direction in the large cap world of stocks. It can play out in all stocks. And so we keep a good eye on what's happening with the Dow Jones Industrial Average. We opened our opening in the chat about the Dow Jones Industrial Average. What we do is we start out with some reasons of what we've seen happening and where we think things are going, and then we make our market call in each asset that we talk about. And so we talked about that the Dow had sort of been in a sideways market for most of 2010, and then it got into a more stronger market in the latter part of the year. A lot of this we think has to do with investors starting to feel that the economic recovery is gaining traction. We also caution that there's plenty of reasons to be careful right now. Valuations are pretty rich. And if you sort of consider the the large amount of stimulus in the economy, the economic recovery has not been that aggressive. Other reasons to be cautious include high unemployment, shaky real estate markets, high deficits, and rapid growing national debt. But having said that, there are signs of improvement in the numbers of late, and if consumers and employers and consumers continue to gain confidence, then the trends in the improving numbers should continue. But you got to keep in mind that we're still in the economy is still in the United States economy is still in recovery mode. Has a fair distance. It has to grow very rapidly for a sustained period of time, a number of years, for that growth to start to make a dent in the unemployment. And another positive for stocks is that in the latter part of 2010, investors started to move out of bonds and into stocks to try and get better returns, which we believe is a smart move. And so basically what we're cautiously optimistic for 2011. Our market call, we think that due to the premium valuations right now, that there's likely a 5 to 10% pullback coming in the early part of the year. After that pullback happens, we think that the trend will get more positive for the remainder of the year and take the Dow up to 12,500 by the year end. The S&P 500 is a broader index of companies, and it's also a fairly good indicator of what's going on globally, as well as in the United States. The Dow and the S&P 500 tend to follow a very similar path as far as the trend in the markets go, and we're looking for the same thing in the S&P 500 as we are with the Dow. We're looking for a pullback in the early few months of the year, followed by a more positive trend. And in the case of the S&P 500, we're looking for a close of 1,400 by year end. Then we talked about the Toronto Stock Exchange. We just did a little brief paragraph talking about how what happens with commodities has a big impact on the economic performance in Canada, and it also has a big impact on what happens with the Toronto Stock Exchange. And basically, this statement is true whether you're looking at the economy of Canada or the TSX. Basically, where commodities go, so goes the Toronto Stock Exchange. And we mentioned that later in the report we talk about our bullish outlook for several commodities, and we think that will also be very bullish for the Toronto Stock Exchange. Our call is for a bullish market trend that takes the TSX significantly higher during the year, with a year-end close of 16,000 points. Then we talked about the Toronto Stock Exchange venture market. Basically, we'd like to keep an eye on the Toronto Stock Exchange because it is populated by many of Canada's large producers of commodities. And then the TSX venture market is a good barometer for what's happening on the exploration side. So this gives you a good idea of not only what's happening with current production by watching the Toronto Stock Exchange, but then by watching the venture market, you can get a good idea of what's happening in regards to the long-term supply chain. And so it's really important for us to follow those two markets, and we think that it's important for investors to follow those two markets as well. And as I mentioned earlier, we have a bullish outlook for several commodities, and we think that that will be very bullish for the Toronto Stock Exchange and the Toronto Stock Exchange Venture Market. And so our market call for the TSX Venture is a bullish trend during 2011, and the index to reach 3,000 points before the end of the year. So then once we got out of our talking about the writing about the our market call for the stocks, then we moved into commodities. And the first commodity we started with is gold. This is often tops on the list of commodities that investors and market commentary is about. We talked about how during the past decade, we watched gold go from $250 an ounce to as high as recently almost reaching $1,500 per ounce. Again, we re-emphasized how for prior to the start of that gold bull market, there had been a couple decades of underinvesting in exploration and new mine development that had weakened the supply chain. With the weakened supply chain, then the demand coming from India and China overwhelmed that supply and drove prices higher. And a good evidence of how weakened the supply chain is what's happened with production from or supply from mining. And the economics 101 sort of tells you when a commodity goes up or an asset goes up or commodity goes up aggressively, then supply will kick in and bring the price down into equilibrium. And in the case of gold and other commodities, gold production has actually peaked and is going into decline as we are now into record prices. And that's record nominal prices. It's not adjusted for inflation, but nonetheless, we are at multi-year nominal highs, and production is actually weakening. Basically, what's happening is not only do you have a long-term period of underinvesting in in exploration, mining companies have to go into riskier countries to find, riskier and more isolated countries to find new deposits and have new production. The deposits that are being found are lower grade discoveries, and so you're going into tougher places to find lower grade discoveries, and the production, you're getting lower grades in the currently producing mines and going deeper in those. So those are main reasons why the supply chain is weak and looks to continue to be weak into the future. We've been bullish for several years, and nothing we see concerning supply and demand gives us any reason to change our outlook. In fact, we are as confident now as we've ever been. Our call for gold is a continuation of the long-term bull market, and we're looking for a year-end close in the $1,700 per ounce range. And of course, whenever we talk about dollars, we're always talking about the commodities in US dollars. So that would be 1,700 US dollars per ounce is our call for gold in 2011. Then we moved into silver. We talked about some of the similarities between the supply chain, exploration, new development, and production. And they're very similar with gold and silver. Silver has other issues. There's not a lot of primary silver mines in the world. Most production comes from mining other metals. Plus, silver is used in more industrial applications than gold. So it makes it somewhat unique, but they still tend to follow a similar path regarding trends and prices. And last year, during several of our TV interviews and on our shows, we mentioned that we felt silver would significantly outperform gold, as it did, and we feel that during 2011 that we'll continue to see gold or silver outperform gold. Although we think they're going to both be in a bullish trend. It's just that we think that silver will give better returns. Last year, silver entered a very bullish trend in the latter part of the year. We've been looking for this for the last few years, and it really kicked in the latter part of 2010. We think that trend will continue, and we're looking for a year-end close on silver of about $40 per ounce. Then we moved into copper. And copper is much like silver and gold. It suffers from many years of underinvestment that has significantly weakened the supply chain. We have prices at record highs, and yet supply is not well prepared to meet demand from rapidly growing emerging economies and developed economies. The mining industry is not even remotely close to finding enough new discoveries or developing enough new mines. Plus, current mines are getting older. They're going deeper for lower grades. These issues, just like gold, they have to go into more riskier countries, more remote places to find it, and that's why the supply chain is in poor condition. And in fact, copper is a commodity that has increasing potential for severe supply shocks in the coming years because the supply chain is so poorly prepared for future demand. And so that when we talk about severe supply chains or severe supply shocks, that's could cause some very big moves and high volatility in the price in the coming years. Mainly, we think that it will drive prices much higher. Another key reason that we follow copper is because it's an exceptionally good economic indicator, and what Dr. Copper is telling us right now is that the global economic recovery is in solid footing. Economic growth in emerging economies is very strong, and developed economies are starting to improve as well. We have maintained a bullish outlook for copper since we started our reports back in the mid-2005, and the main reason was weak supply chain and strong demand, and we think that will continue to drive the price of copper higher during 2011. In 2010, copper was one of the star performers in the commodity space, and 2011 is shaping up to be another strong year for the price of copper. We're looking for copper to reach $5.50 per pound before the end of this year. The next commodity we moved into was oil, and two of the most crucial commodities for global economic growth are copper and oil. We need them to move us around, move our goods around, and provide electricity. And emerging economies led by China and India are rapidly growing the consumer base of copper and oil. And oil has issues on the supply side. Many of the richest oil deposits in the world, the easy ones to get to, have been found. Producers have to go into more challenging areas, quite deep offshore. Other sources is they're putting oil sands deposits are another source. When you have to go into harder places to get it, and it costs more money to produce it, and if you bring the average cost of producing the commodity up, then the price of that commodity, if demand stays strong, has to go higher. And another issue for oil is that it looks like there's a physical limit to how much oil can be produced annually, and peak gold production has already been reached. Key conclusions in the peak oil theory are not about us running out of oil. I have to make that clear, because I think a lot of people haven't taken the time to read the peak oil theory and think that it means that it says that we're going to run out of oil. That's not what it means. It means that what it talks about is there is limits or peak amounts of oil that can be produced each year, and in a global sense, that peak was reached in 2006. Time will tell the accuracy of peak oil theory, but so far it's been very on the money looking at American peak oil production. It predicted a few decades before it happened that America would reach a peak production, and it also made calls on global peak production, and those two calls have been very accurate. But what is certain is that emerging economies are rapidly increasing the amount of consumers of oil, and producers have to produce from deposits that are more expensive, and this is a recipe for higher prices. Our call is for oil to be in a bullish trend during 2011 that takes the price significantly higher. We're looking for it to reach $110 per barrel before year end. Then we got into uranium. Uranium was our final commodity to talk about. Emerging economies are putting strains on supplies of energy. Nuclear is a very important source of energy to meet future global energy demand. Demand for uranium to fuel current reactors is significantly higher than mining supply. If you add in demand growth that's going to come up soon from reactors that are currently under construction, plus those that are in late stage planning, the supply deficit is only going to increase dramatically in the future. Uranium is another commodity that has the potential for severe supply shortages in the coming years. A few years ago, it reached $150 per pound, then went into a serious correction that gained speed in 2008 when the global economy was shaken to the core. In 2010, the spot price bottomed around $42 per pound and then made a very bullish move that took it to $62.50 per pound. And we feel this bullish trend is going to continue. We're very bullish on the long-term fundamentals of uranium, and think that it has the best supply-demand fundamentals of all the commodities we closely follow. Our call is for a continuation of the bullish trend that got underway last year, and a high over $100 per pound by year-end for uranium. After talking about stocks and then moving into commodities, then we talk about bonds, interest rates, and the dollar. And in the bond market, we have argued for the past couple years that the American bond market, or debt market, if you will, had abundant supply and suspect demand, and we felt that there was a major correction in the making. Until recently, we have been wrong on that major correction. It didn't happen. We felt that we started talking about that in early 2009, and it took until late 2010 before some selling pressure started to happen. And so we've been wrong on the market correction side of things, but we think that call was just somewhat early. We do maintain that our assessment that there is abundant supply is absolutely correct. And also, if you take into consideration the amount of buying by the Federal Reserve to prop up the debt market, demand is definitely suspect. When the government has to be the main buyer, that definitely is an indication that demand is suspect. Many investors are starting to decrease their American debt holdings, and the Federal Reserve cannot prop the bond market up indefinitely. No market goes up or down in a straight line, but it does look like the correction that started to get underway in late 2010 will continue. It also looks like the market feels that the Federal Reserve is not going to be a big buyer in the debt market for much longer. Our call is for a weaker trend for bonds that started in late 2008 will continue and will put additional pressure on bond prices. On the interest rate front, since the economy went into a severe slowdown in late 2008, key tools that the Federal Reserve used to stimulate the economy was to be an aggressive buyer in the debt markets and also keep interest rates near zero. These unprecedented efforts by the Federal Reserve have had questionable results, and what makes it even more questionable is how expensive it has been. Now that they've pretty much exhausted all they can, it actually looks like consumers and companies are starting to gain confidence. I think part of that has to do with they're realizing that the feds and the government types are going to start to get out of the way and let consumers and companies gain some confidence instead of scaring them all the time and justifying the actions of the low interest rates and pumping dollars into the system and buying debt. You have to justify that, and when you justify that, you scare people, you scare consumers, you scare companies, and I think that people are starting, investors, consumers, companies are starting to realize that the days of the Fed being so involved in the markets that's coming to an end, and I think that's why you're seeing signs of improvement. It does look like the economy is in recovery, but there are plenty of reasons to still be concerned. As we mentioned earlier, record deficits, record debt, struggling real estate markets, high unemployment that will need sustained rapid expansion to create enough jobs to bring the unemployment down. But with improving signals coming from economic indicators, it looks like the end of the quantitative easing by the Federal Reserve could be over after they finish this current round, although it wouldn't be shocking to see them do another round of QE or a QE3, if you will. Basically, the Federal Reserve can't lower interest rates any more than they have. Zero is zero, and they will not want to slow the economic improvement. And so our call is that the Federal Reserve will not move on rates this year, and will keep them near zero. Then we talked about the U.S. dollar. Some of the key fundamentals that affect any currency is the level of government debt and deficits and the health of the economy. Currencies are no different than other assets. Watching supply and demand can give you fairly good ideas of the upcoming prices. American deficits and debt levels are growing rapidly, and this is a major concern for the currency. And the unprecedented level of economic stimulus is increasing the supply of dollars. And when we see assets with abundant supply and suspect demand, we look for lower prices, and that is the case for the U.S. dollar. Last year, we made a call that currency investors would get better returns in commodity-based currencies like the Canadian dollar over the U.S. dollar. And that happened. It looks like this trend of strength for commodity-based currencies will continue. In addition, we think that the euro is looking very oversold right now and primed for a rally. Bearish sentiment is way too high right now. The bearish sentiment could take the euro somewhat lower, but it looks like the selling pressure is overdone and likely losing strength, and we are looking for the euro to finish bottoming in the early part of 2011 and then head into a more positive trend. We're concerned about the poor fundamentals for the U.S. dollar, and our call is for currency investors will get better returns performance in holding commodity currencies like the Canadian dollar and the euro during 2011. And then we always mention that Then after that after we do our market calls, we then present our roster of favorite treasure hunters. Some of the best places to get exceptional returns during 2010 was in commodities and resource stocks, and we felt that resource stocks would actually outperform the commodities, and they did. The high quality resource stocks definitely did. We talked a lot in the past about mergers and acquisitions in the resource stock space, and that happened again. Since we started our report about 5 years ago, we've picked close to 50 companies. Prior to 2010, we had 3 of those companies that were Wolfden Resources, Peru Copper, and Gold Eagle Mines that were taken over by much larger companies, and those were very successful picks. During 2010, 3 more of our picks were taken over: AUEX Ventures, Underworld Resources, and UTS Energy. And so you won't find those companies in our roster anymore because they've been taken over. We now add them to our Hall of Fame list because they were successful picks that went through the end game of what often happens. And then we presented our roster, and again, we think that high quality resource stocks will give you better performance than commodities, and that's the key reason why we present our roster. On our roster, we have it broken down into commodities. So the first one is copper. We do this by alphabetically. Copper's the first. We have 1, 2, 3, 4, 5, 6, 7, 8 companies in our roster on the copper side. On the diamonds, we have 1 company. In gold, we have several companies. I think it's close to 20. We list the name of the company and when we first started covering those companies in our reports, and you can find all of our past reports on our website in the reports section. So if you want to go back and look at our coverage of any of those past companies, just look for the date and the edition, and you can find those past reports. And you'll also find in those past reports those Hall of Fame companies as well. So then after gold, we've got a couple nickel companies. We've got 1 platinum and palladium company. We have 1 oil and gas company. We only ever pick 2. One of them's been taken over, so that's now in our Hall of Fame list. We've got 3 companies on our silver roster, and then half a dozen in our uranium picks. And again, you can find all of that on our in the recent report. If you are not a subscriber and are watching this show, if you sign up to our email list in the subscription above there, we'll send you out our 2011 Outlook 2011 for the next week to 10 days, and then we give our subscribers a chance to read it and spend some time looking at it before we post it on our website. So in about 10 days or so, it'll be up on our website as well. And so that was our Outlook 2011 report, and we're now wrapping on that. Again, if you want to receive it, just send us an email or subscribe if you're not on our subscription, and we'd be happy to send it to you. And so before closing, we'd like to stress that this show and our reports are for information purposes only. We aren't making buying or selling recommendations. It's important for you to do your own research and speak with your financial advisors before making any investment decisions. We're always trying to grow our audience, and any efforts you make to let your friends know about our reports and our website or our shows would be greatly appreciated. We also greatly appreciate you taking the time to watch these shows. We know that everybody is very busy these days, and we strive to produce a show that saves you time and brings you helpful, high-quality information. Our next show will be tomorrow. We're going to be back into the In the News show mode, and so we'll be talking about some resource stocks with high-quality projects that recently had developments to talk about. And again, to find out about all the work that we do, the best thing to do is subscribe. There's no charge for our subscribing to our reports, and you can find the information above me there. Also, if you want to find out about any of our past shows, we've got a section up there called Shows. In there we have dates, and an outline of the show, what companies were talked about, and links to all the past shows so you can watch them at your leisure. We hope you can join us for our future shows. You can find all of our work on our website at allanberryreports.com. We hope to see you soon. Have a great day.